Here's something most people don't know. The United States now owes more than $38 trillion. That is not a typo. 38 trillion. And every year, just the interest on that debt costs more than the entire US military budget. Let that sit for a second. We are paying more to cover interest than we spend on tanks, ships, and soldiers combined. I'm not a hedge fund manager. I'm not going to pretend I predicted 2008 or that I have some secret formula nobody else has. What I'm going to do today is walk you through a framework built by a man who actually has spent 50 years studying this stuff, Ray Dalio, the investor who built Bridgewater into the largest hedge fund in the world. Dalio has spent decades studying what he calls the long-term debt cycle, and he's written entire books about it. I've read them. Today I want to break down in plain English what he actually says, why some economists agree with parts of it and disagree with other parts, and what it might mean for regular people trying to protect their savings.
Let's start with the basic idea. Dalio says that debt moves in cycles. First, there's a short cycle. That's the one most of us already feel. It lasts around 7 to 10 years. Prices go up, then the economy slows down, then it speeds back up again. You've lived through a few of these already. But underneath that short cycle, Dalio says there's a much bigger one. A long-term debt cycle. This one can last 50 to 75 years. It's much harder to see because most people never live through more than one of them. According to Dalio, we build up debt slowly, generation after generation, because borrowing money now feels good and paying it back later feels far away. Eventually, he argues, the debt gets so big that the normal tools stop working. Interest rates can't fix it. At that point, he says governments are usually left with three honest choices. Option 1 is default. That means the government or its people simply don't pay back what they owe. This is rare in big, powerful countries because it's so damaging to trust in the system. Option 2 is what Dalio calls restructuring. That means lenders agree to accept less money than they were promised, spread out over a longer time, painful but survivable. Option 3, and Dalio has said many times this is the one governments almost always pick, is inflation. The government keeps paying back what it owes, but it pays with money that's worth less than it used to be. Here's the simple math. Say you lend the government $100,000. If prices double over the next 10 years, you still get your $100,000 back, but it now buys half of what it used to buy. Technically, you got paid. Really, you lost half your money. Dalio's argument, backed by his own review of history across many countries, is that inflation is usually the path of least resistance for political leaders, because defaulting looks like failure and inflation is quieter and slower. It's worth saying clearly here, this is Dalio's interpretation of historical patterns, not a guaranteed prediction. Other economists push back on parts of his framework. Some argue that the US dollar's unique role as the world's reserve currency gives it more room to run large deficits than his model of history fully accounts for. Others agree with his broad concern about debt levels but disagree on the timeline or the severity. I'll link some of that pushback in the description so you can read both sides yourself. Now let's talk about where Dalio says we are right now, based on his own public comments, not something I'm inventing. In recent interviews, he has pointed to a few concrete numbers. U.S. federal debt has passed $38 trillion. Interest payments on that debt now exceed the annual defense budget. He has also pointed to a shrinking gap between what stocks earn versus what safe government bonds pay, which he reads as a sign that markets are priced for good times, not for trouble. He has said he believes we're in a late stage of the cycle he describes in his book Principles for Dealing with the Changing World Order, a stage marked by rising government debt, growing political division at home, and rising tension between major powers abroad. Those are his own words and his own framework, and I'm summarizing them accurately rather than putting fake quotes in his mouth. Let me make this human for a second because numbers alone don't stick. Imagine a woman I'll call Linda. Linda isn't a real person I know personally. She's a composite based on stories that show up again and again in the retirement planning world. Linda is 62. She worked as a school administrator for 30 years. She did everything she was told to do. She kept most of her retirement money in a mix of stocks and long-term bonds, the classic 60-40 mix that financial advisors have recommended for decades. That mix has worked well for most of the last 40 years, mainly because interest rates kept falling for most of that time, which made bonds go up in value. But in a very different environment, one where inflation runs hotter or interest rates have to rise to fight it, that same bond portion can lose real value even while it technically pays its promised interest. That's the risk Dalio is pointing at. It's not that bonds are bad, it's that the specific environment matters a lot more than most retirement calculators assume. So what does Dalio himself actually suggest, in his own writing, for people trying to protect their money through a period like this? He's been fairly consistent about a few ideas, and I want to be honest that these are general principles from a very wealthy, very experienced investor, not personalized financial advice for your specific situation. Always talk to a licensed financial advisor who knows your actual numbers before making big changes. The first idea Dalio talks about often is diversification across things that behave differently in different environments, not just diversification across different stocks. He's talked about splitting money across assets that do well when growth is strong, assets that do well when growth is weak, assets that do well when inflation rises, and assets that do well when inflation falls. The idea isn't to guess which environment is coming, it's to own something that works no matter which one shows up. The second idea is that he's spoken favorably, in various interviews over the years, about holding some gold as a hedge against currency and debt risk specifically, pointing to its long history as a store of value during past debt crises. That's a real documented position of his. It doesn't mean gold is guaranteed to go up, and it comes with its own downsides. Gold doesn't pay interest or dividends. It can also sit flat or fall for long stretches. The third idea is keeping some money in short-term, high-quality government debt rather than long-term bonds, because short-term debt is less sensitive to sudden interest rate changes. If rates jump because inflation runs hot, a bond that matures in 3 months lets you reinvest quickly at the new, higher rate. A bond that matures in 20 years leaves you stuck at the old rate while its price falls. The fourth idea, which shows up across his broader writing, is owning productive assets, meaning businesses and real assets that can raise their prices when costs rise, rather than fixed payment assets that can't adjust. None of this is a guaranteed formula. Markets are unpredictable, and plenty of respected investors disagree with parts of Dalio's framework entirely. Some think his focus on debt cycles overstates the risk to a country like the US that borrows in its own currency and controls its own printing press. Others think he underweights how adaptable modern central banks have become. I'm not telling you who's right. I'm telling you what the actual argument is on both sides, so you can think it through yourself instead of just being scared into a decision. If any of this makes you want to look at your own savings differently, here's something practical you can actually do today, not because a countdown clock is ticking, but because it's just good practice. Pull up your retirement account and figure out roughly what percentage of it is in long-term bonds versus stocks versus cash versus anything else. Just knowing that number puts you ahead of most people. Then, if you want, take that number to a licensed financial advisor and ask them directly, how would this portfolio perform if inflation stayed above 4% for several years? A good advisor should be able to walk you through that conversation without flinching. Let's slow down and go a little deeper into how Dalio says the long cycle actually builds, because the mechanics matter more than the scary headline. In his book Principles for Navigating Big Debt Crises, he studied 48 historical debt crises across different countries and centuries, looking for the pattern underneath all of them. What he found in his own account is that early in a cycle debt grows roughly in line with income. People borrow to buy a house or start a business, and their earnings grow fast enough to cover the payments. That part is healthy. Debt is just moving spending power from the future into the present, and as long as income keeps up, nobody notices any strain. The problem, according to Dalio, is that this healthy borrowing tends to keep going well past the point where incomes can keep up. Rising asset prices make people feel richer than they are, which makes them willing to borrow even more, using those same rising assets as collateral. Banks and lenders, seeing prices go up, feel safer lending more. Dalio calls this a self-reinforcing loop, and he argues it can run for decades, which is exactly why it's so hard to see while you're living inside it. He points out that most people who lived through the lead-up to 2008 didn't feel like they were in a debt bubble. Home prices were rising, jobs felt secure, and borrowing felt normal. It only looked like a bubble in hindsight. Where his framework gets more specific is in describing what happens when the debt finally outgrows the income that's supposed to service it. At that point, he argues, central banks first try cutting interest rates to make borrowing cheaper. That works for a while. When rates hit zero and stop helping, Dalio says central banks move to printing money to buy up government bonds directly, a policy usually called quantitative easing, which just means the central bank creates new money to push interest rates down further and keep credit flowing. Eventually, in his model, even that stops being enough, and that is the point where governments face the three choices we already went through: default, restructure, or let inflation quietly shrink the debt's real value. It's worth pausing on the 1970s here, because Dalio has referenced this decade often as a real, lived example of what the inflation option looks like for savers. Through most of that decade, U.S. government bonds paid interest, but consumer prices rose faster than that interest most years. Someone holding long-term bonds through that stretch technically got their promised payments, but the buying power of their money still shrank considerably by the end of the decade. Meanwhile, hard assets like gold and oil-linked investments performed very differently during that same stretch, which is a big part of why Dalio talks about spreading money across assets that behave differently depending on which economic environment shows up. Now here's a second composite story. Again, not a real individual, but a pattern that shows up again and again in financial planning circles. Picture a man I'll call Robert. Robert spent his career as an engineer, retired at 65 with about $1.2 million saved, and moved almost all of it into what his advisor called a safe portfolio, heavy on long-term government and corporate bonds. For the first several years, everything was calm. Then inflation ran hotter than expected for an extended stretch. Bond prices fell as interest rates rose to fight that inflation, and even though Robert kept receiving his interest payments, the value of his account dropped noticeably in real terms, meaning what it could actually buy. Robert didn't do anything wrong. He followed advice that had worked well for decades before him. The lesson people in this situation often draw isn't that bonds are bad. It's that safe depends entirely on which economic environment actually shows up, and most standard retirement advice is built around the environment of the last 40 years, not necessarily the next 10. So let's talk plainly about the 4 buckets Dalio references across his interviews and writing, what each one is actually for, and just as important, what can go wrong with each one, because a fair breakdown has to include the downside, not just the pitch. The first bucket is inflation-protected and short-term government debt. Things like Treasury inflation-protected securities, often called TIPS or short-term Treasury bills. These are built specifically to hold their value if prices rise fast, or to let you reinvest quickly at new rates if the Federal Reserve moves. The downside, in a period of low, calm inflation, these can underperform stocks by a wide margin for years at a time, so leaning too heavily here has its own cost. The second bucket is gold, which Dalio has spoken about favorably many times as a long history store of value that doesn't depend on any government's promise to pay. The downside is real and shouldn't be glossed over. Gold produces no income, no dividends, and no interest. It can sit flat or fall for a decade at a time, as it did through most of the 1980s and 1990s. Anyone buying it purely out of fear, without understanding that it can be a dead weight in calmer years, is likely to sell at exactly the wrong moment. The third bucket is stock in companies with real pricing power, meaning businesses that can raise their prices when their own costs go up without losing customers. The idea is that these businesses pass inflation through to customers instead of absorbing it. The downside is that identifying genuine pricing power in advance is hard. Valuations for well-known pricing power companies are often already expensive, and stocks in general can fall sharply in any serious downturn regardless of the underlying business quality. The fourth bucket is real, productive assets like real estate or infrastructure that can also often raise rents or usage fees with inflation. The downside here includes illiquidity, meaning it can be slow and costly to sell, along with maintenance costs, local market risk, and heavy sensitivity to interest rates on any borrowed money used to buy them. None of these 4 buckets is a silver bullet, and Dalio has never claimed one is. His actual repeated point across his writing is that spreading money across assets that respond differently to different economic conditions reduces the odds of getting wiped out by any single outcome. That's a very different message than buy these 4 things and you're guaranteed to be fine, which is the kind of claim you should be suspicious of whenever you hear it from anyone. If you want to actually act on any of this, here's a grounded, non-dramatic way to approach it rather than an urgent countdown. First, figure out your real-time horizon. How many years until you actually need this money? That single number changes almost everything about how much risk makes sense for you. Second, take an honest look at anything in your portfolio you hold purely out of speculation or habit rather than a real plan, and ask yourself whether you could explain, in one sentence, why you own it. Third, if any of Dalio's arguments genuinely resonate with you, bring the specific numbers, your account balance, your T. Horizon, your risk tolerance, to a licensed fee-only financial advisor, and ask them directly how a change in inflation or interest rates would affect your specific mix. Fourth, keep reading views that disagree with Dalio too. Economists like Paul Krugman and others have pushed back on how much weight to give debt cycle theory for a country that borrows in its own currency, and hearing that side matters just as much as hearing Dalio's. I'll leave you with the same disclaimer I'd want if I were watching this instead of making it. This video is an independent, educational breakdown of publicly available arguments from Ray Dalio's own books and interviews. It is not affiliated with Ray Dalio or Bridgewater Associates, and it isn't personalized financial advice. Debt cycle theory is one lens among several ways economists think about the economy, and reasonable, well-informed people disagree about how much weight to give it. If you found this useful, I'd rather you go read a chapter of one of his actual books than just take my word for any of it.